Hello, everybody, and welcome to Deschutes Title's class today. I'm Kevin White, the state manager for Deschutes Title, and just want to welcome everybody for being here. Hopefully, y'all can hear me now. We apologize for a little tardiness there in getting going. We had some IT or tech issues as usual with the Zoom. Just to let everyone know, if you're new to one of our Zoom webinars, this is a webinar, not a Zoom meeting. And so you won't be able to see everybody. You'll only be able to see Brian and myself. And then in order to interact, you would use the chat feature, the raise hand feature, or the Q&A at the bottom. So feel free to use any of those. If you use raise hand, I can then unmute you or ask you to unmute, and then you can ask a question verbally. Otherwise, you can type the question in the Q&A or the chat feature. And this just allows us to record this and represent it later in an easier fashion on our website, as well as get the records necessary for the state to issue the CE class. Just so you know too, we have Brian with us today, and Brian is with Fairway Mortgage. Brian will be sharing insight with regards to home equity conversions, and we appreciate Brian and his expertise. I've known Brian for, I think, over 20 years now, and he has a wealth of knowledge when it comes to mortgage, and we appreciate him taking time out of his schedule to present this today. So with that, I'm going to turn it over to Brian and let him take it away.
Awesome. Thank you, Kevin. And thank you to the rest of the Deschutes team, Kimmy and Nicole and Jenny, for helping put this together. Yeah, my name's Brian Albrich. I am with Fairway Home Mortgage, and I've actually been a loan originator based in Bend, Oregon since 2002. And so anyway, probably about 2018, I had the opportunity to go back to our corporate headquarters in Madison, Wisconsin, to learn about the home equity conversion mortgage. And so today we're going to talk about the home equity conversion mortgage. Now, most people don't know it as the home equity conversion mortgage. Most people know it as a reverse mortgage. FHA likes to call it a HECM. So that's why what this home equity conversion mortgage means. So what we're going to learn today is basically how to use a reverse mortgage to purchase a home. Now, there needs to be one person in the household that's at least 62, but that only needs to be one person. In the past, well, you always needed one person to be 62 or older, but if there was a person under 62, that person had to be removed from title, which was problematic, as you might imagine down the road. If the older spouse passed away, the younger spouse is not on title. That created a whole bunch of issues. So, what exactly is a reverse mortgage or HECM? Before I go too far, because I can just start rambling here, please feel free to interrupt me anytime. I enjoy answering questions, and I want this to be informal. I really just want to really create an awareness about this product, that kind of how it works, and then how it could potentially help your clients, or even you personally. So there are different types of reverse mortgages out there. This is the most common. The FHA version is the most common. That's like I said, the HECM. There's about 1 million Americans that are currently in these loans right now. They're FHA insured. So, I'm going to point out a lot about the safety of these, because whether you heard it, your clients may have heard it, 99% of the people on the street hear it. That I generally hear that, people that don't talk about reverses all the time, they think, oh my gosh, those are those scary products where you can lose your house. Now, FHA didn't go into the business of doing these loans to take people's homes. And so that's why I point out that it's actually not only FHA insured, but it's a non-recourse loan, meaning if you ended up owing more than your house is worth someday because you lived in the home for 40 years and you're got it at 62 and you're 102 now, nobody's on the hook if you owe more than your house is worth. It doesn't even show up on your credit report. So that's kind of an interesting thing. Now, what you can borrow, you can borrow up to a percentage of 1,249,000 and change. So if the house is worth 500,000, you can borrow a percentage of 500,000. But if it's 5 million, you can only borrow a percentage of 1,249,000. That's a
Hey,
it's
Brian,
an FHA. Yeah, go ahead.
there is a question in the queue that just said, does it matter if the owners want the property held in a trust?
No, it does not. As a matter of fact, I would say, gosh, 70% of the reverse mortgages I do are in a trust. So we just get a copy of the trust and we have a legal team that reviews it. But yeah, no, we do those all day long. So no problem. So reverses in general came out in the late 80s. And that the Hecken for Purchase product that we're talking about today actually came out in about 2009. It primarily came about because what was happening before then is people would pay cash or get a traditional loan to buy the house and then 2 months later go get a reverse so they didn't have a mortgage payment. So luckily FHA, they move slowly, kind of like a glacier sometimes, but it took them 20 years to figure out. By 2009, they figured out that maybe we should just allow people to get, right out of the gate, get the reverse when they purchase it so they don't have to do two transactions. As I mentioned, there's a lot of safety features built into these. One is now both borrowers can remain on title even if one is under the age of 62. So consumer protections. There's counseling required because of what people have heard over the years. The spouse that was too young had to be removed from title. FHA has made sure that there's counseling required. Now, it's a couple of different reasons for that. One is they want the people to understand, that the borrowers to understand what they're getting into. At the end of the day, this is just a mortgage, but it's a mortgage that allows you to never make a payment for as long as you live in the home. And on the note, it actually says you can live in the home till you're 150. So if you live till 150, as long as you meet some minimum obligations, which are property taxes and homeowners insurance, you never have to make a payment. Now HOAs as well. A couple of these are regarding that. There a lot of these are used for financial planning tools. There was a thing back in the day where maybe a bad actor in the mortgage world with a bad actor from the financial planning world were convincing people to pull money out of their house to buy an annuity. So that's been fixed. There's actually a document that they have to sign that they're not going to go use this money to buy an annuity. There's initial disbursement limits that doesn't really apply with the reverse because you're maximizing what you can borrow. And we'll go into that here in just a little bit. There's a credit and income review. Now, I think they used to just give these away well before I ever did a reverse mortgage, kind of like the old days of the mortgage world. In 2007, for example, if you were over 62 and had a pulse, you could get a reverse mortgage. And now they want to make sure that by doing the credit and income review that, maybe something's not going on. They have the ability and the wherewithal to make their payments on property taxes, homeowners insurance, and meet the basic qualifications. But that being said, we don't use a debt to income ratio like a traditional mortgage. So if you have somebody with just a fixed income, there's often times where we can qualify them for a reverse where there's no way they can qualify for, say, a 30-year fixed. Um, I talked about the protections for the non-borrowing spouse. That's the non-borrowing spouse being under 62. Um, the HECM line of credit, we're not going to talk about that, but for a little bit. Now, 99% of reverse mortgages are the borrowers choose to use the adjustable rate mortgage versus the fixed rate mortgage. And probably 100% do it with the purchase. The reason being is you are allowed to borrow based on your age because there's life expectancy on these and the current interest rate. And the interest rate on the fixed rate is a higher interest rate, so you can borrow less. So most people that use the HECM for purchase choose the adjustable rate mortgage. And in general, they're right about where the 30-year fixed are. So we'll go over that in a little bit. And like I said earlier, it's a non-recourse. So let's say somebody got one of these and was in the home for 30 years and never made a mortgage payment, and the balance has gotten bigger over time. And then we go through 2008 again, and their home value drops in half. Well, because it's a non-recourse, if they owe more than their house is worth, they can just walk away with no credit hit, no nothing. Now, if they do want to sell it to, say, a family member, they can sell it at 95% of current market value. So let's say they purchased a home with one of these, and down the road they end up owing $400,000, and we go through 2008, and their house is only worth $100,000. That's market value. So if they wanted to sell their home to their family, they could sell it at 95% of current market value, so 95 grand. Everything owed above and beyond that, in this case, I said they owed 400, is forgiven by FHA because it has FHA insurance. Any questions on that? All right. Okay. I just wanted to point out, I pulled this slide. I do these presentations for financial advisors as well, but a lot of the stigma about reverse mortgages is, in my opinion, is that retired actors like Magnum PI, Henry Winkler, the Fonz, retired senators have been pitching reverse mortgages for the last 30 years on late night TV. And I think it's really done a disservice to this product, because at the end of the day, it's an FHA insured mortgage. And so these guys, you see, this isn't Magnum PI. None of these guys are. They all have PhDs. And the reason why I point them out is they've done vast amounts of research from the academic side and proven that a retirement is actually safer by having a reverse mortgage within as a complement to the entire retirement plan. This guy, Barry Sachs, I like to point it out because he's the first guy to ever get published in the Journal of Financial Planning about using a reverse mortgage in retirement. He has a PhD in theoretical physics from MIT and a Harvard Law degree. And he was a tax planning attorney in San Francisco. And when he retired at age 73, 86 now, still sharp as a tack, he proved that retirement is more efficient by using a reverse. He actually has a reverse on his home in downtown San Francisco. And because he has that, he has a second home in Napa Valley as well. So, okay, we're going to get back, go into kind of how the basics, and then I'm going to show you a couple examples of how these are used to actually purchase a home. So as a reminder, one person in the household needs to be at least 62. The home needs to be FHA qualified. So, and we'll go over that, what that means. Anybody that's sold real estate probably gone through with just a traditional FHA loan. It's no different. The appraiser just has to look at a few different things, make sure there's no health or safety issues, and that there's no exposed wood on the side of the home. That's one of the funny things about a reverse mortgage or FHA loan is if there's any exposed wood, even on the trim, it has to get painted before somebody can close. Now, you can make payments, although 99.9% of people choose to not make payments. But if they're still working and they want to make a payment, there are some advantages to that. Anytime you do make a payment, one, it keeps your loan balance from getting bigger over time. And two, dollar for dollar, because these are actually a line of credit, your line of credit grows. So let's say you decide to you're still working, you're 62, and you're going to work for 5 more years. You could make a payment of, say, $2,000 a month. It buys your balance down by 2,000, but it also grows your line of credit. So at the end of the year, you've paid $24,000 into this loan. And because it's a line of credit, you could draw it back out. What if the roof blew off and you need to fix the roof or something? You could pull that money back out. So as far as a safety feature for a senior, because these are a line of credit, and if you do make payments, there's nothing wrong with having a little extra liquidity to draw from. Life happens, not only a roof, maybe long-term care or whatever. And as I mentioned earlier, there's a minimum credit and income requirement. And that's just really to make sure that they have the wherewithal and the means to meet their obligations, because there's no mortgage payment, but they do have to pay out of pocket property taxes and homeowners insurance and HOAs. How am I doing here? Any questions so far?
No questions in the queue currently, Brian.
Okay, thanks, Kevin.
Yep.
Okay, so I talked about that it has to be a FHA approved home. What makes up an FHA approved home? So it's got to be under a 4-unit property, so 1 to 4 units. Now, the interesting part about this is you could actually get a duplex, let's say in retirement, and live on one side, get a reverse mortgage, buy the duplex, live in one side, and rent out the other side, all the way up to a 4-unit. So that would be kind of an interesting retirement strategy for somebody. Maybe they don't have a pension or whatever, but they do have the means to buy a house. Well, maybe they could turn it into income producing opportunity for themselves. Now we can do manufactured homes, and just like a regular FHA loan, after June 15th of 1976, HUD started. They went from mobile homes to manufactured homes, and so HUD puts a little label on the back. I'm sure all you real estate agents have seen that. The appraiser goes in, takes a picture of that to prove that it's FHA or HUD approved. We can do condos, planned unit developments, townhomes, and to your person earlier that asked about the trust, we can definitely do trust. Just gonna get a little sip here. I feel like I'm just rattling away, so I hope I'm not boring anybody. Okay, the opportunity that I see, one, just I think that the general knowledge of how these work, I think, will help you in your business in general, because there's such a negative attitude about these. And at the end of the day, I just want people to understand that these are FHA insured loans. They're extremely safe, and they're really the reason why they came about in the first place is to help seniors age in place. That's a financial planning term, but that's the reality. So here's your clientele, you guys. Right now, seniors have an estimated $14.7 trillion in home equity across the United States. There's 15 million people that qualify as seniors homeowners. It's the largest asset class in the United States. And there's currently approximately 11,000 people a day turning 62. let's see if anybody is listening here. Maybe you could respond in the chat. How many of you have had senior clients that are possibly priced out of the market? I know on the regular mortgage side, applications are way down. I would imagine it's affecting senior home buyers as well. Anybody?
I'm looking, yes.
At least one person?
Quite a few people are all saying yes.
Okay. Okay. All right. Cool. This is, like I said, not only creating awareness about this, but I want to show how potentially some of those people that are priced out could buy a home, and be in the same position as somebody that put 100% down. They because if they're financing with the reverse, they don't have a mortgage payment, so it's the equivalent, but they don't have to put 100% down. So, percent of retirees who have moved or anticipate moving, 27% of that 15 million has not moved yet. 36% don't anticipate, and 37% have already moved. Reasons households choose to move. Last year, approximately 4.2 million baby boomers moved homes. And the interesting thing, most people think about grandma or grandpa downsizing and all that. Only 51% of people actually that seniors downsized. A lot of people upsize or maybe right size. Maybe that would be a better term, moving into a house that maybe has more amenities that they have. Maybe their current house has a bunch of deferred maintenance and they want a brand new home. It's interesting, statistically, a lot of seniors that use a reverse for purchase end up buying a brand new home, and it kind of makes sense. They've probably been living in the family home for a lot of years, and it's got deferred maintenance, and maybe they had kids in that house, and maybe they're just time to just kick back a little bit and not worry about that. And you move into a new home, and it's everything's working, and the roof doesn't need to be repaired for 20 plus years. So it seems to make sense why people would right size it into a brand new home. Reasons seniors move in retirement. One of the big reasons, wanting to move closer to family. I actually did a reverse for purchase the other day. They were moving from Arizona, and I'm actually licensed in 9 states, and so they're moving back to Boise, where they have brand new grandchildren. They weren't exactly happy about moving back to the cold, but they were really excited to be near the grandkids. So they sold their house in Arizona and moved up to Idaho and to be closer to family. Reason for moving, another one, and this is where I try to talk to a lot of financial planners too, wanting to reduce home expenses. Now, deferred maintenance and mortgage payments. A lot of financial planners say, well, Mr. and Mrs. Johnson, you don't have $10 million in the bank. We recommend that you just sell your house, pay off your debt, and just go rent. Well, the reality is, with the reverse for purchase, they might be able to be in an amazing situation to actually go buy and not have a landlord and get to do the things that they want to do with their house and not what their landlord does. Change in health status. My screen just moved.
Yeah, you went into a different mode. We can still see it, but we can see everything now.
Oh, you can?
Yeah.
Okay. So I just need to get down to, that's interesting. I must have bumped my mouse or something.
Yeah, so we can see you scrolling and everything, but yep.
Okay. So you see reasons for moving in retirement?
Yep.
Awesome. Okay. So yeah, change in health status. It's interesting. 67% of people over the age of 65 end up having some type of long-term care need. Now, if you don't have a mortgage payment, maybe you can just get somebody to help you out in your own home versus have to go into a long-term care facility. 12% marital status. The term in the financial planning world is silver divorce, but it happens, people get married and divorced at any age. Empty nesting, wanting the cash from the sale of their home. Like I said, a lot of financial planners try to get them to sell their home, pay off a bunch of debt, and then go be renters. All right, so I'm going to just kind of compare a few different options on, traditionally what people think they need to do versus what they could do with the reverse mortgage. So the heck and purchase advantages. So 3 ways to buy a house we're going to look at here. We're looking at a $550,000 purchase price. With the traditional mortgage, you have to at least put 20% down. So in this case, they put 20% down. Their required monthly payment at 6.25%, which is about what the rates are today in a 30-year fixed, they'd have a $2,700 a month payment. That's $32,000 a year that are either using their Social Security or pension or drawing down from IRAs or whatever to make mortgage payments. Maybe they have a bunch of money, or maybe they just have enough to pay off the house, because there's a ton of people that think that they have to be debt free in retirement. And I think what needs to change with reverse mortgages, yes, it's a debt, but it's a no obligation debt, meaning there's no monthly payment. So in this case, they would have to, let's say they had $600,000. So they're like, okay, I want to buy a $550,000 house and be debt free. Well, if they do that, they put all their money into the house. The house is an asset. It might be a nice house, roof over their head and all that, but as an asset, it's illiquid. Now that person that had 600,000 only has 50,000 for everything. Or you could do a reverse for purchase. As I mentioned earlier, they can borrow based on their age. So if we have a 70-year-old person looking at a $550,000 home, they would only have to come up with $355,000. The rest would be in a reverse mortgage. So in the case that I just mentioned, they had $600,000. Let's say they had sold a home, paid off the mortgage, and they had $600,000 left over. Well, they could put $355 down and pocket the other $250. They could put it in an interest-bearing account. They could put it, with their financial advisor. They don't have a mortgage payment, just as if they had put $550 down, but they only put $355. They have $250 in the bank and no mortgage payment. Seems like a pretty awesome way to retire. So anyway, here just some general numbers based on using the reverse to purchase. As I mentioned, the younger you are, the less you can borrow. And here's why. Because you don't have a mortgage payment, interest accrues over time. Because at the end of the day, it's just a mortgage. So interest accrues. FHA doesn't want, although it is that non-recourse loan where you'll never owe more than your house is worth, FHA really doesn't want you to owe more than your house is worth. So as you see, a 65-year-old would need to come in with about 70%, but an 80-year-old would only need to come in with about 59%. Interest rates affect this number too. During COVID, that was the optimal time to get one of these. All these numbers were about 15% better. So a 65-year-old would have only had to come in with 55% because the rates were at zero. Now we're at a normal interest rate environment. So we good so far? I'm guessing Kevin's going to tell me if anybody has a question. All right. here's an example of somebody downsizing.
Oh, sorry, Brian. I thought I had unmuted. There is a
Okay.
question. What happens if the home, what happens to the home after they pass?
Yeah, so great question. If they owe more than their house is worth, which is like less than 1% of the time, then they can just walk away from it. 99.9% of the time, there's going to be equity left. And so, um, if let's say there's only one person living in the household and they pass, they leave it to their family through the trust or their will, and the family can sell the home just like if they had had a 30-year fix. The cool thing is they have up to a year to sell. So right out of the gate, they have 6 months. They have to prove to this, they have to call the servicer and say, "Hey, my mom or dad just passed away," and the servicer would say, "Do you want the house, or are you going to sell it?" And most kids don't want the house. They want it because we're talking kids that are in their 50s, 60s, and maybe 70s. So they're going to sell the home. So they're going to hire a real estate agent. So you sell it for whatever the market value is, pay off the remaining loan balance, and the equity goes to the family, just like if they'd had a 30-year fixed. One thing I want to point out, and this is from the financial planning perspective, people say, well, don't get a reverse mortgage because you're not going to leave a lot of equity to your family. Well, that's right. You're going to leave less equity for your family, but there's a couple benefits. Grandma and grandpa didn't have to like struggle to pay their bills or eat because they had a reverse mortgage. So they didn't have that obligation that they would with a normal loan. And those financial PhD guys actually proved that with the reverse mortgage, generally, people, even mass affluent people, all of their other assets do better. Because let's say there's a market, the stock market drops in half, like it did several years ago. Well, instead of drawing to continue making mortgage payments, you don't have a mortgage payment. So all those other assets generally do better. So yeah, you'll have less equity in the home, but generally have more in their savings account or other retirement vehicles. So here's a situation where this lady, she's 70 and she's selling her current home, which she owns free and clear, to move closer to her grandchildren. She wants to downsize and she wants to set up an annuity for her grandchildren to help pay for college. Her desired community is more expensive than her current one. A reverse mortgage can allow her to purchase a home in the new community and be able to have money left over from the sale of her current home. So right now, Cindy is in a $600,000 home that she owes free and clear. And she's looking at a brand new $525,000 home. So she sells $600,000 home, and of the proceeds, she uses $336,000 in change as a required down payment to buy this $525,000 home. But left over is $221,000 of the proceeds because she didn't have to put all of the money down into the purchase. She has $221,000 left over. Now, in this case, it has her buying an annuity. She could just throw that in the bank. And now, guess what? Cindy could go on vacations. She doesn't have to worry about going out to dinner with their girlfriends. It provides more liquidity to somebody by not having to dump all of their money into the home, which is a financial asset, is illiquid. So, any questions on that?
I don't see any questions currently in the queue.
Okay, awesome. So, and I'm going to look at, like I said, only 51% of people are using these to downsize. The rest are actually right sizing or upsizing. So in this case, you have a 64-year-old couple, James and Mary. They want to move into a newly constructed home to retire. The home values in their desired community that they're looking at are much higher. And a realtor recommended a home equity conversion mortgage so they could afford to buy a new home in the community that they want. So let's look at this. James and Mary currently have a $627,000 home that they owe free and clear. So, but they want to buy in this other nicer community, $817,000 home. They don't want a mortgage payment. So they sell their home for 627 after expenses to sell. They still have a good chunk of money left over. With the $817,000 home, they only have to put $514,000 down. So they can move into an $817,000 home with only 514 down and still not have a mortgage payment. So it's this took it a little bit of extreme. They don't necessarily have to go to 817. Maybe they bought a $675,000 home. Then they have a lot more money left from this house in a side bucket in a savings account or whatever. Okay, just general benefits of buying with the Heckam for purchase. They could buy in a 55 plus community. I was shocked to see the other day as I was just doing a little research on some marketing stuff that I'm doing that Lennar Homes actually has a legitimate 55 plus community here in Central Oregon. I thought that was pretty cool. It's going to have a clubhouse and the whole bit. I got to meet RJ over there, and it looks like it's going to be a nice deal. So as I mentioned, a lot of seniors, they don't want to move into a home with deferred maintenance or needs a lot of fixing. They want to move into a house that's ready to go and they can get on with their life. They've raised their kids and they just want to relax and enjoy life. So that's pretty cool to see that. But you can use it on any home. Like I said, you can use it on a manufactured home. Doesn't matter. Increasing purchasing power. It's interesting, if somebody does go into a brand new home development, being that they don't have to put 100% down to avoid mortgage payments, a lot of times they end up getting the house with the upgrades. I know Lennar doesn't do any of that, but a lot of builders, you say, hey, here's the base model, but if you want all these things, it's going to be, I don't know, 10% more or whatever, because you're only financing, 60 to 70% of it. I'm sorry, 40% of it. You're coming in with 60, 70%. A lot of times people end up getting the nicer house that actually fits what they want. As I mentioned, there's no more mortgage payments except taxes, insurance, maintenance is required. So they're not driving by to see if there's dandelions in the yard or anything like that. They just want to make sure that the house isn't in a total state of disrepair. And they can, use it to move closer to family, better weather. If they're moving to Central Oregon, they might be moving from a place that their house isn't worth as much as here. And this is where maybe that strategy of, James and Mary of buying the more expensive house with the reverse could still fit their needs. Excuse me. Again, they got to put about 45 to 70% down, depending on their age. The one thing, you guys will all appreciate this, all the realtors on here. We can close as fast as 17 days on these. Fairway is a unique in that regard. We are a traditional mortgage company with a reverse mortgage division. We understand it's extremely important to close fast. And on our normal side, we close extremely fast. And on reverses, we're best in show. Close really fast. And that being said, there's several reverse mortgage companies out there. We are top 7 in the country, number 1 or 2 in purchase transactions in the country. Here's something that is really awesome. And this just came in, excuse me. I get old and I start losing my I get a frog in my throat now that I'm 59. So all right, seller concessions can actually have the seller contribute. It actually, property seller, real estate agents, builders, or developers can contribute up to 6% of the sales price, which is really awesome. They can cover origination fees, other closing cost fees, and even the initial mortgage insurance premium. Like any uh, government mortgage, even a traditional FHA loan, there's a funding fee. On the forward side, it's 1.75%. But if somebody uses a VA loan, it's 2.15%. Or if they use a VA loan the second time, it's 3.3% of the value of the loan. In this case, are it's 2% of the home value. So it's pretty big, and that's why you got to put so much down on these. But so this is really exciting that that can actually partially be covered. Sit break. All right. How to introduce these? As I mentioned, there's this stigma about reverse mortgages. Um, if you're talking to your client and you might not even want to bring it up, but if you're like, man, they're so close, they're over 62, to really talk to them about that. Um, a lot of times you're going to get this. Oh no, is that terrible reverse mortgage that I've heard so much about? Because it's funny. I sit down with people all the time and they go home and they talk to their gardener, they talk to their nurse, they talk to their dentist, they talk to their Aunt Sally, and everybody says you should never get a reverse mortgage. And nobody knows why. But because what happened 10, 20, 30 years ago, with that, like I mentioned, if you had a spouse that was too young to be on the original loan, that could create issues. And also the counseling has helped reduce a lot of issues too, because now we actually underwrite and counsel folks so they understand that they actually have to pay taxes and insurance. What happened back in the day was that people would pull all the money out if they weren't using it for a purchase, and then they would stop paying their property taxes. And guess what? They got a lien against their house. And they would have also gotten a lien if they owned their house outright. But because this is a mortgage, the mortgage company doesn't really like other liens on the house. And so they would reach out to the borrower and say, hey, you're behind on your property taxes. And maybe they just couldn't catch up. So that created a lot of egg. And so these are things. If you're working with a lender, you want to bring them in into the conversation. But at the end of the day, what keeps me going is I know thought leaders like those financial planning people with PhDs and FHA being backing these things. They really are an amazing product. Just got to get over that initial hurdle of people just kind of going, oh my gosh, those are crazy. So how to address that? Um, as I mentioned, FHA has cleaned up these. Those original reverse mortgages don't even resemble what they do now. One, you go through counseling. Two, you go through underwriting. And three, they used to allow people to borrow more out of the house. So, as I mentioned, nobody loses their home and you still own your home. I didn't really point that out. That's one of the biggest misnomers is that the bank owns the home or the government owns the home. That's not true. The only people on title are the people that the borrowers in the house. And then when they pass away, if they pass away while living in their home, they can will it or let the trustees get the home, the beneficiaries, and they can sell the home. So these are backed by the federal government, but not owned by the federal government. I've heard a lot of crazy things about that. Um, let's see. Yeah. Anyway, any questions on that? guys are so quiet. Throw
Yeah,
something at me.
no questions currently.
Oh, okay.
I'm watching though. I'll interrupt if you do.
All right. Thanks. Okay. Executable ideas. A lot of you responded saying that you have had talked to people that are priced out of the market. Um, maybe you have people that have stopped pursuing purchases due to sticker shock. Well, because you don't have to put 100% down or finance it with a 30-year fixed, maybe that can help you reapproach some people. Cash buyers with limited mortgage qualifications. Again, because you don't have to put 100% down, maybe they can buy a home even at today's current values. And as I mentioned, they're a lot easier to qualify. So maybe you have somebody, they have a big chunk to put down on their home, and maybe they just have Social Security. Well, if we use what's called a residual income and not a debt to income. So if our underwriting shows that they have enough to pay property taxes and homeowners insurance, then they could potentially get one of these and move into a brand new home, even on a fixed income. Um, Again, I talked about getting more home, buyers who didn't want to settle for less desirable home. Because you don't have to put it 100% down, a lot of people get all the upgrades or maybe the bigger house. Buyers that are stuck in a competitive price point, but if possible, would move up to a higher price range so as there's more inventory and less buying pressure. So again, that's just that whole right sizing or upsizing. Yeah, and
A
this is just
couple
yeah, please.
questions here now.
Awesome.
Can you explain the advantage of H4P versus just selling their home and buying a new one with the proceeds?
Yeah, actually, um, well, so as I mentioned with Cindy up here, um, so yeah, you could buy a brand new home, but in retirement, um, what if you buy a house for cash and now you don't have any cash left to actually live life? So this is a way to take those proceeds and use less of them. Like I said, anywhere from 45 to 70% of the purchase price. The rest remaining, like in Cindy's case, whoops, she sold her house for 600. She only had to put 336 down and still not have a mortgage payment, but she had 221,000 left over that she could have to actually live life and not be house poor. So that would be the advantage. Does that make? Do you have a follow up to that, or?
I'll see if they come back. I think the other advantage, of course, is there's no payment, right? You're finally
Well,
in
yeah,
retirement.
it's
You
no
don't have a
payment
payment,
without having to put 100%.
right?
Yep, no payment. Don't have to put all of your money into an illiquid asset, which is the house. You can put that and put it somewhere that you have access to if your car breaks down or you need long-term care or whatever. Cindy would have this extra $221,000 left over and still not have a house payment.
She said that answered it, so thank you.
Oh, okay, cool. Um, I mentioned Fairway. We're at the end of the day, we all go off of FHA guidelines. Um, we have a whole division. I didn't mention I'm senior vice president of our reverse team. We have 7 of us throughout the country. I happen to be one of them. I'm licensed in 9 Western states. Locally, I actually am the person that meets with the clients and walks them through and their agents through all of this. So you would get me, and we have a dedicated reverse team. And one thing that's really cool, I actually have a signing this morning. It's a refinance over in Salem. We're the first company in the country that does reverses to offer an e-signing. Because this is how crazy, because it's a government loan, there are so many documents. I feel sorry for these seniors. They have to sign like 200 pages we've cut that down in half by being able to e-sign some of it. So that's pretty cool. Um, yeah. Any scenarios? I mean, we've got a few minutes here before our hour's up. Um, if anybody wants to throw something at me, I'd be happy to
Open for
give them an
questions.
idea.
Um, and to answer one question in the chat, yes, I will have this presentation posted to our website hopefully by later this afternoon.
Awesome. Thank you, Kevin.
Yep. And I don't see any other questions. Does anyone have any questions? Give everyone a chance to actually type them in.
Sure. And please know my contact information's here and Kevin's going to post it. If you have any scenarios or you just want to, don't want to ask in front of the crowd here or whatever, feel free to reach out to me directly. My cell is right here. It looks like we forgot to put my email address, but I can get that to you as well.
One question is, what states are you licensed in?
Yeah, that is a great question. Just off the top of my head, I'm in Oregon, Washington, Idaho, Montana, Nevada, Arizona, Hawaii. Um, hmm, actually, yeah. Is there a state you have in mind? And I'll tell you. Here they are, right in front of me.
Yeah.
Arizona, California, Hawaii, Idaho, Montana, Nevada, Oregon, Utah, and Washington.
Okay, most of the West.
And by the way, Fairway is a national company. And so if you have an aunt in like Illinois or whatever, I have a colleague in Illinois that could help them out. So I could hook them up. But I could be your local contact and, run preliminary numbers. And there's a lot of education with this product, as you might imagine. Most of our work is actually, compared to a regular mortgage, is up front, sitting down with them. They go to their family, they go to their financial advisor, they go to their CPA. But once we're through all that and they're all in, then, like I said, we can close really fast, like as fast as 17 days. So,
any other questions? I don't see. You're getting lots of thank yous.
well, thank you. I really appreciate all of you taking the time to be here today and listen to me ramble. I hope it was brought some value to your business.
Yep, no other questions at the moment. So thank you, Brian. Really appreciate
Okay,
everything that you shared. Good
you bet.
information, and I will have everyone's certificates. We'll probably get those out no later than Tuesday. You might have them by tomorrow, but no later than Tuesday next week, you'll see your certificate. If you have any questions, just reach out to me. In that certificate, we'll try to include Brian's contact information. So, all right. Thank you very
Okay.
much. Appreciate it.
All right. Thank
Oh,
you.
wait,
Have a great
we
day.
do have something in the question.
Oh,
Can you
yeah.
work with someone in St. Helens, Oregon?
Oh, St. Helens,
Other part,
Oregon.
yeah.
Yeah, absolutely.
Okay.
Yeah, I'm doing I'm helping a really nice lady over in Salem
Okay.
today. Actually, they're signing right now. So, absolutely.
Okay.
COVID kind of made us really comfortable with this kind of stuff. So I do a lot of that. I do bomb videos. After I talk to them on the phone, I'll follow up with a bomb video and they can watch it, share it with their family. So yeah, absolutely. Really comfortable doing that.
Okay. Great. Awesome. Thank you very much. I don't see any other questions. Everyone's just saying great info. Thank you. Appreciate the informative class. So,
Okay. All
and we
right.
thank you too, Brian, for taking time out of your day to do this. And like I said, I'll get everyone's certificates out no later than Tuesday next week. So,
Okay.
all right.
Yeah.
Thank you very
Thank
much.
you, Kevin, and your team at Deschutes.
Appreciate it. Okay.
Okay.
Bye.
Take care. Bye.